Good morning, everyone. Appreciate everyone that is logged in and registered. My name is Brad Scheibler. I'm with Capital Management Corp. I have Tim Call here, who is Chief Investment Officer as well. We appreciate everyone taking some time out here to do a Q&A here on the current financial markets. Just a little bit about the webinar. If you have a question, you can go ahead and type it into us as well. We already had a number of people reach out to us directly, so really appreciate that for questions. And we're not really going to do a whole lot of slide decks because personally they put me to sleep if I watch more than probably 5. So we're just going to kind of go free form with the questions we've gotten. And as you hear something that may spark something else in you, please go ahead and open up the question dialog button, and it will pop up on our screen, and we'll be able to address that with Tim. And we look forward to having a fruitful discussion here today. So Capital Management Corp is a little bit about us here. We've been around for 50 years, but Tim took over in the early 2000s and has developed several strategies here, mostly audited Gibbs strategies. Actually, all of them are. And it's been doing this since, he likes to say, since the 3rd grade. So we'll just kick right off here into the questions there right now. So first one we got here was, obviously there seems to be, Tim, equity markets face a number of obstacles, it seems, in the next 3 months. We have had the Federal Reserve raise rates here and expect to raise rates again in December. The U.S. is yet to resolve its trade disputes with China and other partners, outside of Canada and Mexico, obviously. And then the coming midterm election cycle is obviously contentious. So how do you hedge your risk, especially within your own CMC strategies with these?
Well, these there are always risks in the market, and it's like when you turn on the news every night. There are always going to be negatives, and that's what makes good news. So we hear about these negatives. Many of them are priced into the market already. But how we're looking at these different issues, rising interest rates on a security-specific basis, we're not buying stocks that get hurt by rising interest rates. Highly leveraged companies or companies that have a lot of floating rate debt outstanding, they will be hurt by rising interest rates. Flattening yield curve, that will be that's not good for banks, with borrowing and lending costs being too close to each other. The interest rate spread's too narrow for them to make fast-growing profits. But we're in other financials that just benefit from rising interest rates. So you can be in stocks that benefit from some of these trends. China appears to be priced in at this 10% tariff level. It doesn't hurt the United States that much because on a relative basis, China exports to us much more than we export to them. And when we're adding to a cost of goods that we're buying 10%, that's just a small part of the entire value chain. So by the time it gets to the consumer, it's much less than 10%. And with elections, in recent election cycles, the midterm election actually provides October with a positive 4% return. When we look back 100 years, it's certainly different. But what's happened is, as we get through October, people get more and more certain as to who will win. And the market hates uncertainty. So we go into an election cycle with high uncertainty. And as we slowly get more and more certainty, the markets historically have risen, especially in the second half of October, for many years, but not every year. And after the election, then seasonally, the strongest part of the year for stocks is November through April. So So we take all of this into account. The long-term trends are a little bit more important. The short-term events tend to be already priced in. The long-term effects affect companies' fundamentals on a long-term basis, and that in turn affects security prices. So we pay great attention to that and how that affects companies over the next 5 years, and they don't have to negatively affect you. You can be in the beneficiaries of these trends, and that's the beauty of owning individual securities as opposed to an index.
That's great, Tim. And then our next question here, Tim, is we have a Warren Buffett fan. That's a shocker. They said that they believe in Warren Buffett's value investing, and they kind of want to understand what you look at value-wise with investing at CMC, but specifically they want to understand, what sectors you're looking at S&P 500. Would you be a buyer of utilities? Would you be a buyer of consumer staples? What do you think is you see the underlying value in the market today? Obviously, with equities at all-time highs, where would you be investing?
Well, certainly, Warren Buffett's earned his great reputation. There are many cycles underneath the averages. So we see the averages hitting new highs. And the 100-year return for the U.S. stock market's 10% per year. That's rather good 100-year track record. If on average you're up 10% per year, then on average most days you'll be hitting new highs. Of course, nothing's in a straight line, so we don't have that every day. But in a normal market, you are hitting new highs just because of that 100-year average. But underneath those averages, there's a lot of movement. So some sectors can go in and out of favor, also value versus growth. And we have many other trends. So small caps versus large caps, international versus domestic. So there are many multi-year trends going on underneath the averages. And it makes it so certain segments of the market are, we believe, undervalued. They're cheap. And other segments are rather expensive. So right now, we think utilities are very expensive. They've been a bond substitute. So if you couldn't get a good interest rate on a bond over the last 5 years, maybe you bought a utility stock to get that return. And because of that, utilities went up in price. Well, now interest rates are rising. So a utility, if they're not increasing their dividend by a great amount, as interest rates rise from 1% to 2%, 2% to 3%, that utility becomes less and less competitive with bonds. So those bond investors that bought utility stocks, many of them will be selling now. And that will make the stock prices go down in that sector, which will alert other investors that this is not as attractive as they thought, and then they will sell. So sometimes selling can result in more selling, and the stock prices should go lower for utilities as interest rates rise. There are other sectors that benefit from rising interest rates. So in the financial sector, the non-banks benefit from that. And then when we look at interest rates going up, usually it's because the economy is strong, and a stronger economy usually means the consumer is strong. The consumer in the United States is almost 70% of economic activity. So many consumer stocks should benefit from that. And the ones that benefit the most are usually called consumer discretionary or consumer cyclical. That means they do better when the economy is strong than when the economy is weak. So in general, we like that sector of the economy. But again, just like financials, within that, we would favor some areas versus others. So those companies offering experiences like a cruise line, those stocks in general are very attractive right now, where other companies like retailers that have to compete with Amazon and the internet in general, they are under great pressure with their fundamentals, their profits, and so we will stay away from those. And it's a similar story in technology. There's some attractive parts to that sector that are undervalued, but there are other parts of the sector that are overvalued. So in general, we like financials, consumer cyclicals, and technology stocks. We like those sectors of the stock market, but we will be highly selective within each sector because there are some overvalued parts of those sectors or fundamentally flawed parts in this economic environment. Other cycles, other than sectors, you can have small caps versus large caps, and large caps have done very well for several years. So there are many small caps that are undervalued. And then growth versus value. Growth has greatly outperformed value in the last 3 years. And over a long period of time, value actually outperforms growth by a tiny bit when we look at 50 or 100 years. So after a period where growth greatly outperforms value, we would expect reversion to the mean, which means value would start outperforming growth. So anyway, value is actually cheap right now and is very attractive. So just by putting money into the stock market doesn't mean you're buying the whole stock market. You can buy selectively. So if you think the stock market is fairly valued or overvalued, you can still buy undervalued securities and reap the rewards as they both grow as companies and have their valuation metrics return to long-term averages.
Appreciate that, Tim. Boy, I guess we have a lot of investing icon followers here. Next question is around Peter Lynch. Specifically, Tim, when you're looking at stocks, you just mentioned the cruise lines there. Is that kind of how you go around selecting stocks? You own what you kind of buy into, or how would you you look at investing in a stock in today's market and adding to one of your strategies? How would you evaluate?
Well, what we'll do is, out of all the stocks that trade daily in the United States, and there are a little bit over 3,000 of those, we would sort them quantitatively, just based on, mostly based on excess cash flow, growth of that cash flow, all relative to the company size, to its capital base, and also growth of earnings. So this, when you do this on a multi-year basis, this generates a short list relative to 3,000 stocks. We can get just 10% of those 300 stocks that are extremely attractive, both on earnings growth and a cash flow generation basis. It's important to have both because cash flow basically lets you know the earnings are real. If you're producing a lot of earnings and not generating any cash, something's wrong with the business model or with the accounting. So it's important to have both. And Enron had supposedly they had earnings growth according to the accountants and auditors. They did not have cash flow growth, or they actually weren't generating cash. So those kind of companies can't make it through the process. So we're highly selective, just looking at then 10% of those 3,000 stocks. And that's where we start our fundamental review. We want to make sure these are companies that not only are very profitable now, but will continue to be profitable in the future. We want leaders in growing profitable niches that can be defended well and have long-term growth. So we come up with a little bit less than 100 stocks that we want to own. We think they're great companies, but some of those are overvalued. Other investors have realized they're great companies and their stock prices are too high. So even though it's a great company, if you pay too much for a great company, you might not have a good return. So we want the best of both worlds. We want great companies with long-term growth, but we also want an attractive entry price. That way, over the years, you can not only compound your return with the dividends and the earnings growth of the company, but you can also receive valuation multiple expansion. So valuation is very important, and that's how we get to our best ideas. So we have an approved list of 40 to 50 stocks that comes out of that process. It happens 2 of the cruise lines come out of that process. Royal Caribbean, which has a very attractive dividend yield, and Norwegian Cruise Lines, which does not pay a dividend yet, and it might change that policy in the next 2 years. When talking with management and seeing how much cash they're generating, they are looking forward to returning some of that to shareholders, as well as continuing to reinvest in their fleet. So we come out with a select group of high conviction ideas, rather diversified across many sectors, across market capitalizations. Some are labeled as growth companies, some value companies, but these are what come out of our process as the 40 to 50 best investment ideas that pass all of those hurdles. And from that, then you can create portfolios. So a client who needs to generate income for retirement, they would only be in companies that have higher dividend yields. So Royal Caribbean might be in their portfolio, where investors who just want total return, just want the highest reward, they don't care if it's through dividends or stock price, they're more likely to have Norwegian Cruise Line in their portfolios, because we think that will grow at a faster rate. It's a smaller company, and they have certain benefits that they're receiving. So we're very excited about these 40 to 50 stocks. And then the last step is creating those portfolios. And it depends what the individual client goals are: wealth preservation, growth, income generation, and what their restraints are, such as timeline and tax status.
That's great, Tim. Hey, we're gonna bear with us one second. We're just pulling together some of the questions that are coming in right now. We have a few questions that are coming in right now. Bear with us one second. Okay, thank you. Right now, we have questions that just came in. Saw a report out of the Wall Street Journal yesterday about the Boston Fed president saying damage to China's economy is likely to spill onto other countries due to trade tensions, and likely backfire on Trump and the U.S. What are your thoughts on Trump and what the Boston Fed was saying, Tim?
Well, it's good to hear all the opinions. When it comes to China, the Chinese government claims that the economy is growing at 6% there. Whether it is or not, the government over there is closely following the economy. They want all their people employed so they don't have idle time to think about revolt. So to keep all of your citizens employed, you have to have a growing economy. If their economy slows down to 4 or 5% growth, the government, which controls a great deal of the economy, including the banking system, the government will print a lot of money and order the banks to make more loans. So anyway, they have ways to boost their economy. And when it comes to finding people to buy their goods, they're lowering tariffs now for many countries. They're doing what the United States has been asking them to do. So they might not do that for us near term, but they're doing it for everybody else, and that will help them with exports to other parts of the world. So we don't see China going into recession because of this. Also, when we look at the Chinese economy, it's better diversified now than ever before. It's 1/3 agriculture, 1/3 manufacturing, and 1/3 consumer. So again, there are many reasons why we don't think China is going to implode or lead the world into recession. The country should be just fine, and these tariffs actually have a very small effect on the United States and the consumer here.
Next question is, what's your view on ETFs as a way to achieve diversification? Obviously, ETFs are a lot cheaper to invest in than active managers, but I'm starting to get a little nervous with the volatility in the markets. Should I be switching away from ETFs and more into fixed income, or what?
Well, ETFs, exchange traded funds, are like a mutual fund, but mutual funds only price once per day at night when the market's closed, and you have to put your orders in when the market's open. ETFs, you can trade during the day and can trade at a slight discount or premium to their underlying portfolio value. The portfolios tend to be indexes. So the company can create an index, but the vast majority of ETFs closely track an index. So these are index funds. On average, index funds are cheaper than actively managed funds or actively managed accounts. So the fees are a little bit less. So instead of paying 1%, maybe you're paying part of 1% in fees. But you're buying an index. So if you want to own that index, or if you think that index is diversified, then great. You have the index by buying the ETF. If you think value is going to start outperforming growth, or you think some companies are overvalued, the index owns all the companies in that index, and you don't want to own the overvalued companies, then you want active management and only own what the manager thinks are undervalued companies. So indexes and ETFs have their place, have their positives, but you might be able to do better with an active manager, and that's why it's good to look at track records. So you can look at the track record of an index and of a manager. You'll want to look at audited GIPS compliant results. So that is something you should ask for from any active manager, and in your selection process. So, and then from that, you can see how well they do in down markets and up markets, and what their long-term track record is versus the index that you're considering investing in.
Next question. First, I'll have to leave out the name of the big broker they named here, but it's a large broker. Their financial advisor stated that to them recently that they should be looking at annuities, the lock-in gains. Based on what you've been saying here, Tim, what's your view around annuities, the lock-in gains for tomorrow?
So I don't see how that would lock in gains. So if you sell some securities, I guess, and
it might help if you explain what an annuity is too to everyone. I'm not sure everyone knows what an annuity.
Right. So it's an insurance contract, basically, that can hold mutual funds in some cases. So you can have a fixed contract that might not hold mutual funds, or you can have a variable contract which certainly does. Annuities are a great deal for the broker or for the person selling the annuity. Most have 10% commissions, so 5% on the variable annuity or the annuity structure, whatever it is, and another 5% on the load funds that you'll put into a variable annuity. So the total commission 10%. It makes it one of the highest commission products in the United States, in the financial markets. So brokers they're highly motivated to sell these. So it's a great product for the brokers. We think it's a bad product overall. There are a lot of people who think that the federal government was about to crack down on annuity sales. Anyway, that's been stalled recently. So if you want insurance, I'll go out and buy term life insurance. If you want market exposure, I'll go ahead and buy the market. But to buy something with a 10% commission that might have continuing commission after that, so it's a very high fee product that few people understand, and that long term underperforms the U.S. stock market. I just don't see an advantage to that, but you will hear a lot about it and asked if you want to buy it a lot because brokers are heavily incentivized to sell them.
Next question is, this is interesting. I'm in my 80s. I've done very well in my career. I have enough money to cover my expenses, healthcare, everything, and I'm not worried about myself. But I do have one child who's in their 30s who I do have concerns about. I've been told by financial advisors that I should just still abide by the old age theory of invest in fixed income based on my age. How do you feel about that? And what should I go back to my advisor with on that?
Well, I would look at each pool of money that you have and figure out what the goals and constraints of each pool is. So you have your probably living trust, you have your IRA, your Roth IRA. You have all these different buckets of money or different individual accounts, and each one can have a different timeline. So for your retirement in your 80s, maybe your timeline is shorter than 20 years. That affects how you want to invest the money that you're going to spend during retirement. If your accounts are large enough, maybe the cash income the accounts are providing is all you need to live off of. In which case, you're going to leave a lot of your money to your child. Well, your child has a different life expectancy. So let's say your child's and grandchildren are in their 20s, 30s, or 40s. So they have a couple of decades till they retire. And then once they retire, they might have another couple of decades to live. So they could have 40 or 50 years ahead of them where they need this money to grow faster than inflation. They need the corpus or the principal to grow faster than inflation. And on top of that, they will want to generate income to live off of or to pay certain expenses. So in that sense, you have a very long-term time horizon where you need growth as well as income. So you do not want to be heavy in bonds if you need growth out of your investments because bonds just generate income. In general, they don't grow. So inflation chips away at the principal of a bond every year. So when we're looking out 40 or 50 years, the principal keeps going down by a great deal. And at a 3% interest rate for the 10-year Treasury right now, if you reinvest all your interest, then you're just staying level. You're not growing wealth at all after inflation. So it really depends on the timeline for each account, what it's there for, immediate spending or spending in 5 years, or whether it's for somebody's inheritance. And that will then tell you how you should allocate each account between stocks and bonds.
We have another Wall Street Journal question here from a listener. Tim said the S&P 500 has had its best 3-month performance since 2013. The current bull market is basically at its longest in history. What is your outlook for a sustained longevity of this bull market?
So the bull market's been very long. It's defined by a bull market will stop at a 20% pullback in the market. Those are called bear markets, and they generally correlate with recessions. We don't see a recession in the near term, so we're not forecasting any bear markets. The economy itself, while it's technically been growing for many years, it's been many years since 2009, it hasn't grown that much. So if you're growing at 1 or 2%, it feels like you're not growing. So this year we might have some quarters that experience 4% growth, and it's normal for the first 2 years of a economic recovery to have 4% growth. And so we're not necessarily at the end of the economic cycle by any means. We don't yet have inflation that's out of control, and we don't see the typical excesses. We don't see the warning signs for a recession right now. We actually see some extraordinary positives for the market right now, such as this. The tax law actually helps companies for not only this year, but going into the future. There are great ramifications. The lower regulations, you can say there are lots of positives or negatives, but it's positive for business. The repatriation of foreign profits is very positive. And then the consumer finally having a job and growing spending, that's very positive. So we still see the stock market doing well over the next 2 years. And usually there are warning signs before recessions. So we are looking out for those, but we don't see those at this time.
Another question, where do you see the interest rates going in the next 12 months?
So we see them going up. The Federal Reserve governors make speeches from time to time. They've seemed to indicate they're comfortable in aggregate with one more rate hike this year and at least 2 next year. Well, so we're at roughly 2% overnight interest rates. The next hike would be 0.25%, probably before year end, bringing us up to 2.25%, and 2 more hikes bring us up to 2.75%. Historically, that's a very low overnight interest rate. So your bank accounts might start paying you something as opposed to absolutely nothing. So that's nice. But anyway, going up to 2.75% or 3% by the end of next year is not harmful by historical measures. We think long-term rates should be higher. Historically, long-term rates are 2 percentage points higher than short-term rates. So the 30-year bond should have a 5% interest rate when the overnight rate's close to 3%. So that wouldn't surprise us for interest rates to be at that level, 5% for the 30-year and 3% for the overnight by the end of next year. But what would surprise a lot of people, in our interest rate forecast is higher than that of others, but what would surprise a lot of people is how much money they can lose in long-term bonds when interest rates rise. So when interest rates from these levels just rise 1 percentage point across the board, then the holder of the 30-year bond receiving close to 3% interest, their bond value will go down by roughly 17%, because in a 4% interest rate environment, no one wants to buy a 30-year bond that has a 3% coupon. So you would have to lower the price of your bond by 17% to sell it. If interest rates go to 5% on the 30-year, you can lose even more. So some bond investors will be negatively surprised as interest rates rise. Others who have short ladders can reinvest at higher rates as their maturities come due. So the interest rates do have a meaningful effect on the bond market and on individual companies. And we certainly pay attention to that when building portfolios.
Yeah, so the next question that's coming in is around emerging markets. I'm a big watcher of CNBC, and everybody I keep seeing on there keeps talking about emerging markets. Essentially, that the U.S. equities have had such a good run that we need to start looking across the water there. What's your view on emerging markets?
So emerging markets is a broad category. Sometimes the majority of that category does really well. Sometimes it does awful, and sometimes it's muddy waters. So right now we're in the muddy waters. You have several countries that were doing well a year ago are not doing well right now. So Argentina, it looked like it was coming out of the mess. They were in a year or two ago. They were able to issue 100-year bonds, which is hard to believe since they defaulted on debt at least 5 times in the last 100 years. But Turkey also was growing very well. But both countries, for different reasons, have stumbled greatly. And then other countries, emerging markets, are going to stumble as interest rates rise and as their currencies fall in value. Any dollar-denominated debt they have will be much harder to pay. So we're going to have a couple of those rise up and become problems. In aggregate, we expect economic growth in the emerging markets. So in aggregate, the fundamentals are okay, but since several countries are going to experience big problems over the next year, investor sentiment might be negative, so the valuation of emerging market stocks could be under pressure still for another year or so. When the outlook looks cleaner and clearer for the majority of emerging markets, then I think that will be an attractive place to invest because valuations are lower right now in the emerging markets.
Next question is, my financial advisor just recommended that we should go to all cash and wait for a pullback that is bound to happen. What's your viewpoint on this, and what should I go back to my financial advisor with on that point?
If somebody is that good at market timing, they would have so much money, they'll only be managing their own money. So market timing historically doesn't work for the vast majority of people. And going back to the icons of investing, they don't market time for good reason. So when you feel like market timing, when you feel confident in the market and you want to go all in, well, the market's priced for that, which means the market might be overvalued. And usually you're buying at the top in that case. And when everybody's panicking and the news on the TV is even more negative than it is now, that's when valuations are low. So when you just can't take it anymore and you have to move to all cash, you're probably selling closer to the bottom. So market timing tends to be awful for most people. It really detracts from returns. On top of that, the U.S. stock market has that 100-year average of being up 10% per year. So if you're out of the market for different periods of time, chances are you're missing out on that long-term return in the markets. There are a lot of people who say, "Oh, I'll invest in the next pullback," and the next pullback comes because there's more uncertainty or negative news, and because of that, they don't go into the market. Well, that's the time you want to go into the market is when there is negative news, because the market's discounting for that, so you're getting in at a better price. Anyway, I would not market time. I'll be a long-term investor. The money you have reserved for long-term investment in stocks should be invested in stocks. Anything you expect to spend in the next year should be in cash or money market. And in that way, you can sleep at night, and you don't have to worry about calling the exact top and the exact bottom, which no one can do.
That's great. We probably have time for one or two more questions here. This one here, another Buffett fan. Buffett has always talked a lot about concentrated portfolios, and that that's definitely the way to make a lot of wealth. What's your viewpoint on concentrated portfolios, Tim?
So concentrated portfolios, if created correctly, can have great results, and we've seen that over time. So you have Buffett, you have other portfolios that you can cite that have done very, very well, and one can use disciplines that work over very long periods of time, and if you strictly adhere to those disciplines, then history suggests you can build a very strong track record. So in that sense, we believe in concentrated portfolios. Just because it's concentrated in fewer stocks, you don't have 100 stocks, you might have 20, 30, 40 stocks. That doesn't mean you have to give up diversification. You can still have some of those stocks be growth, some value, some be small cap, and some be large cap. Some have global exposure, and some have purely domestic exposure. And you can still have stocks from most of the sectors of the economy. And I think you would want diversification in a concentrated portfolio. You don't have to give that up. Diversification has lots of benefits. That lowers your volatility. So we do believe in concentrated portfolios. All you have to do is create them well and strictly adhere to disciplines that work over time. By the way, those are very hard things to do. So somebody can say they do that, but you would really want to look at their long-term audited track record to see if they've actually been doing it.
That's great. And then, one thing here, Tim, I had a last question here. I think we're going to take. We've been going for 45 minutes strong.